Hello, in this lecture we're going to continue our discussion of Economic Institutions, Chapter 3. Chapter goals, remember, are to define market economy and compare and contrast socialism and capitalism, describe the role of businesses and households in the market economy, list and discuss various roles of government, and explain why global policy issues differ from national policy issues. All right, so now we're moving on to businesses. We're going to discuss some business types in this case. So we have businesses are private producing units in our society. So notice what the businesses are basically going to be held privately, owned privately, and they're going to be the individual, the sources of the production. So when we think about in terms of who decides what to produce and what not, the businesses are basically deciding what they should produce in their particular business. And when you think about the economy as a whole, then the network of, or the idea of what's going to be produced overall in the economy not being driven by a centralized unit that is trying to decide what should be produced everywhere. It's driven by individual or separate businesses who are making those decisions for their particular businesses. So businesses in the U.S. decide what to produce, how much to produce, and for whom. So notice within our business, we're going to decide, we are, of course, going to be the ones making these decisions. So if we think about the economy as a whole, these were our main questions that we often think about. Who's going to decide what to produce, how much to produce, and for whom to produce it? Well, if you think about the economy as a whole, you could think, you could think of it as a kind of one big business where you try to have one central body making those decisions for everybody. But again, that could be somewhat difficult, especially as a country, with a large country with a large economy. In this case, we're saying that we're kind of having the invisible hand, do that by having individuals, businesses make that for their purposes, and then the aggregate of all businesses together are what are basically making the choices of what to produce, how much to produce, and for whom in aggregate. Now, we'll talk about how the consumer fits into that as well, because notice that the business does not have complete control. The business is also governed by the invisible hand when they're making these decisions. They're free to make these decisions, but they're tied up in cases of do they want to stay in business or not, and they'll have to make the right decisions if they want to stay in business. So business produce what they believe will sell. So this is where the consumer is going to take precedent here. Note that obviously the business owner has the option to do whatever they want. It's their business. They can do whatever they want. They can decide what to produce, how much to produce, and for whom, based on any kind of criteria that pops into their head. However, if they do not produce stuff that the consumers want, then they're probably not going to sell, and they're probably not going to be a business for long. So note that businesses do not have complete control. It's often thought that the consumer actually is more control, is really driving what should be produced, because the business is going to go in and trying to find that need. They're going to try to find the thing that's not being provided, or the service that's not being provided, that they believe that people will want, and they're gonna supply that resource. Meaning that means that the person in the driver's seat is really the person who's willing to purchase things rather than the person producing the thing. By channeling the desire to make a profit in the general good of society, the U.S. economy system allows the invisible hand to work. So here we go with that invisible hand again. And note what that concept is. It can be a little bit difficult to wrap our heads around, because we're basically saying that these two individuals, that both the business and the consumer, have their self-interest in mind. And that actually works out better than if we had the other person's interest in mind. So we don't go into the store saying, I'm gonna buy something in order to help out my neighbor grocer. We go into the store saying we want to buy something at the reduced price. And then, of course, the grocer's not saying that I want someone to come into my store so I can help the community. They might put that on their advertisement, but we know that obviously a large part of their activity has to do with making a living, generating revenue. And by those two individuals having their self-concern and being knowledgeable about things, they will come to an agreement that is fair, hopefully, to both parties, meaning both parties are better off, meaning the store making the sale is better off, the individual buying the goods are better off. They're both better off by going into an agreement and laying on the table that they are basically after their self-interest for the most part. Although business decides what to produce, they are guided by the consumer's sovereignty. So this is again kind of the idea that the consumer is really the person that is in the driver's seat, even though the producer is making what is being produced. So because of the invisible hand, because of competition, because we're not being governed by just one central body saying this is what we're going to produce, make, and get to this quota, what we are saying is you're going to produce whatever is going to sell, and no one's actually saying that. That's just the invisible hand saying that. And if that doesn't happen, then the business will go out of business. So the real authority there is in the consumer, because they're the ones that are making the ultimate decision within the market as to which businesses will thrive and which will probably die. So business forms. So if we think about the types of businesses, we got the sole proprietor, we got the corporations and the partnerships. These are very general. There's, we can get deeper into subcategories, but we can see that the sole proprietor, if we just counted the number of sole proprietors, they would account for like 72%. What's a sole proprietor? One owner, very small business, easy to form, one owner, 72% of the businesses. If we think about corporations, they're going to be a separate legal entity, a little bit more difficult to form, a little bit more expensive to form. And we'll talk about the pros and cons in a second, but we'll see that they have 18%. So there's far more sole proprietors, of course, than corporations, partly because it's a lot easier to form a sole proprietor and they're a lot smaller in size. Partnerships are kind of like a sole proprietor, except now you got two people that just started a business. So again, fairly easy to form, and they're at 10% if we were just to count the partnerships. Now, if we were going to look at revenue, however, then we know that, of course, the corporations are very large. Well, there are some very large corporations, and therefore they have a lot of people involved in those operations, and they generate 81% of the revenue. So by far, if we count revenue and not just count the number of types of organizations, the corporations account for a lot more. The sole proprietors, only 4%. And again, this flip-flop looks really startling if you just take a look at the two numbers, but also just realize that, of course, the sole proprietors is anybody that one person that starts a business. So clearly the scale of a sole proprietor is going to be a lot smaller than the scale of especially a publicly traded company who has a lot of employees and a lot of people involved, and then 15% for the partnerships. So if we think about these types of entities, sole proprietor, partnership, and a corporation, what is a sole proprietor? That's a business that has only one owner. So notice that it's really easy to form. You don't really need a separate tax document. They're not going to file a separate tax return. They're just going to file a separate form on the tax return, pretty much. And if we just start doing business, if we just started selling stuff, whatever that may be, if we just started selling jewelry or whatnot, we would be a sole proprietor. So sole proprietors, it's pretty easy to form. Same with a partnership. So if we just got two people and they got together and started doing something, they had a business idea and they just started implementing it, they'd basically be a partnership. And any revenue they get, they would share in terms of the profit sharing agreement. A corporation, on the other hand, is a little bit more complex in that a business that are treated as a person and are legally owned by the stockholders who are not liable for the actions of the corporation person. So what that means is a corporation, you got to put a little bit more money in order to start the corporation and run the corporation. It costs some money to regulate the corporation. But the idea of the corporation is relatively new, and that is that we're basically given rights to a piece of paper, a corporation, a non-human thing, and we're given human rights to it, such as a corporation. The corporation, not the people owning the corporation, is the thing that basically owns the property of the corporation. So the corporation owns the bank account, the corporation owns the building, and we, the stockholders, then own the corporation. So we're a step removed from the actual ownership, and you might say, well, why would we do that? And some advantages of that is that if we're trying to collect capital, notice that if we're saying I need some investments for my business and we were a sole proprietor, then if we put money into the sole proprietor and the sole proprietor went bankrupt, then they might be able to come after our personal assets, our house or something like that. Same with a sole proprietor. If we have a corporation, however, and we say, hey, the corporation is its own entity, it could provide some liability protection to investors, stockholders. And therefore, if the corporation got sued, you can sue the corporation, take the corporation's bank account, take the corporation's building, and go after their assets. But theoretically, you shouldn't be able to go after the stockholders. And what that does is it allows, of course, things like what we have today, where we have investors who don't know a whole lot about the corporation, who are able to invest their funds into business. So if we have a 401k plan or something like that, we put money into businesses. We're basically owners of the business, but we have a very small ownership. And if we didn't have this separation of liability protection, we would be taking on too much risk in order to make that type of investment most of the time. And so that's one of the advantages that really kind of boosted our level of production and our level of having capital. So here's that broken down a little bit in a table here. So a partnership advantages: minimum bureaucracy. Obviously, one person can run the entire partnership. And direct control over the ownership. So if an organization is small, then it sometimes and oftentimes is very beneficial to have if you have one good leader or one good person that knows how the business runs, and the business is manageable small, then it's good to have a command-based business oftentimes, because that one person can't manage that. However, if you move to a corporation where the corporation is large, oftentimes that corporation could have been started by that one sole proprietor, but now that the corporation's large, maybe multi-state, multinational, one person is going to have a lot different challenges in that situation. It's a lot more difficult for someone who wants to be involved in every piece of the operation to go from a small operation in a sole proprietor to a corporation. At that point, you got to kind of decentralize sometimes. Disadvantages to a sole proprietor: limited ability to get funds because we can't issue stocks. We can't generally issue bonds. So it's going to be, if we want to gain capital to invest in the business, not quite as easy to do as, say, a corporation, in which case we can, issue stocks and whatnot. Partnership's pretty much the same thing as a proprietor, except now you got two people instead of one or more than two. Ability to share work. It's really flexible in terms of how we can set up the agreement on how to share the profit sharing, which is really nice. Relatively easy to form. Again, same thing as a sole proprietor. We start doing business, we are a partnership. Limited liability to get funds, same problem. Unlimited personal liability, same problem as with the sole proprietor. Now remember, the benefit of the corporation is that you have no personal liability. That's going to be meaning that the corporation assets should be sued, but since they own the assets separate from the shareholders should have a corporate kind of shield and not be liable unless they did something personal. Obviously, if the management of the corporation committed fraud or something like that, then there could be separate legal action taken for that act of misrepresenting the corporation. How did they misrepresent the corporation? They were acting as an agent of the corporation, and they lied. So that's kind of fraud. So fraud type things within management can happen, and of course that could allow someone to be liable for their actions. So increase ability to get funds. We can issue stocks and bonds, which could increase the ability to get funds. Ability to avoid personal income taxes. This could go both ways. I mean, the corporation gets a separate tax return. So in the U.S., the corporation pays taxes because they're like a separate individual and they pay taxes. However, as we see in the disadvantages over here, if the corporation then distributes those taxes to the owners in the form of a dividend, now the tax could get taxed twice, which is a kind of a large problem with corporations, because now it got taxed on the corporate side, and then when you gave it to the owner, it got taxed over here. And that doesn't happen with a sole proprietor. It only gets taxed one time on the return. It's also, of course, a lot more expensive to get a corporation set up and to run it and to file the tax returns and whatnot, and to monitor the corporation's more expensive to do that. So most of the time when people incorporate, it's usually because they're trying to generate funds, capital investment, and or they want that separate legal liability protection. Also note that there's two other kinds of entities worth noting here. And one is an S corporation, which is geared towards giving the advantage of a corporation being separate from the owner, but it has a flow through similar to a partnership. So you're trying to avoid this idea of double taxation. And there's limited liability partnerships or companies which have the same type of thing. What they're trying to do is give that corporate shield without having this double taxation and maybe give some more flexibility in terms of how partners are divvying up the income from the operations.